oil surged by more than 20% last month. Geopolitical tensions intensified. So why did Indian markets continue to rise? What helped India outperform the US and most Asian markets last month? And what should investors do as these risks continue? Stay with me as we answer these questions and understand what could shape markets in the coming month. Hi, I am Saurabh Shrivastav, Head of Research at MFA, and you are watching Story of the Markets. July delivered an outcome that very few investors would have predicted. The US-Iran agreement reached in June broke down. Tensions returned around the Strait of Hormuz, while attacks in the Red Sea created an additional risk to global oil supplies. As a result, Brent crude rose by more than 20% during this month, touched $95 per barrel, and closed near $88. Despite this difficult global backdrop, Indian equities remained resilient. The Nifty and Sensex gained for the second consecutive month and outperformed S&P 500, Nasdaq, and most Asian markets. So what supported India? First, domestic economic activity remained healthy. GST collections for July stood at 2.11 lakh crore, growing more than 15% year-on-year, the fastest growth in 14 months. Industrial production grew by 7.3% in June, supported by manufacturing and electricity. Strong growth in electrical equipment was particularly encouraging, as it points to continued momentum in the capital expenditure cycle. Second, foreign investors returned to Indian equities. After 4 months of selling, FPIs invested around 20,200 crore during July. Domestic institutional investors added approximately 35,100 crore, continuing their strong support for the market. The rupee also remained broadly stable, which helped investor sentiment. Third, a sharp correction in global artificial intelligence and semiconductor stocks encouraged investors to look beyond crowded technology trades. India benefited from this shift, and the Nifty IT index recorded its strongest monthly performance in several years. However, there are important risks to monitor. The biggest near-term risk for India remains crude oil. If Brent stays above $90 for an extended period, it could increase India's import bill, put pressure on the rupee, raise inflation, and reduce the RBI's flexibility to lower interest rates. India's CPI inflation had already increased to 4.38% in June, driven by higher food and fuel prices. Global interest rates also remain a risk. The US Federal Reserve kept rates unchanged in July, but 3 members voted for an increase. Markets are now considering the possibility of a US rate hike in September, which could influence global liquidity and foreign investment flows. In India, the RBI's policy decision on 5th August will be closely watched, although most economists expect rates to remain unchanged. The monsoon is another important factor. Rainfall during July was below normal and unevenly distributed. If rainfall does not improve, food inflation and rural consumption could face some pressure. On the positive side, first quarterly corporate results are showing improvement in both sales and profits. Valuations have also become more reasonable after the correction earlier this year, although selectivity remains important. So what should investors do? Our investment approach remains unchanged. Continue your regular investments and avoid reacting to short-term geopolitical headlines or a single month's market performance. Do not chase a fund or sector simply because it has performed well recently. Investors with surplus capital can use market corrections to deploy gradually rather than trying to predict the exact bottom. Keep your portfolio aligned with your asset allocation, investment horizon, diversification needs, and near-term liquidity requirements. Thank you for watching Story of the Markets. Until next month, stay focused on your long-term financial goals.